Have you ever had a trade that looked perfect, but somehow the market moved the opposite way? Well, it's not bad luck. It's not stop hunting. It's because you still don't understand how the game is being played at the highest level. Most traders lose not because of their strategy, but because they are entering the right trades at the wrong timing. Markets don't move randomly. They move in certain cycles. And if you don't understand which phase of the cycle we are in right now, you're basically flying blind. So in this video, I'll break down the 4 market cycles that smart money use to time entries, right trends, and avoid retail traps. So you can finally stop guessing and start aligning your trades with real institutional flow. I'm talking about billions, if not trillions of dollars that is in the market right now. And to be honest, this is something that I've not seen anyone talk about yet in the trading industry, even though it's so important that you actually understand this. Well, this is part of the study of fundamental analysis. Fundamental analysis is the study of macroeconomic, political, and monetary forces that influence price on a deeper, longer-term level. What this means is that we are essentially studying how the economy of a particular country affect the strength or the value of a currency of that particular country itself, right? So this is pretty much measuring the economic conditions like interest rates, monetary policies, inflation, economic growth, all these fancy economic jargon. What they pretty much means is that if the economy is booming, the strength of the currency is going to go up, right? So if US economy is thriving right now, everybody have jobs, everybody spending money, this just means that the strength and the value of the US dollar is going to go up. And then the opposite is true, right? If the economy is shrinking and contracting, it's not booming, it's not going crazy, then the strength of the US dollar is going to go down. And the entity who is in charge of regulating the economic growth is the central banks, right? These are the Feds, this is Jerome Powell's army, all right? So they are pretty much in charge of making sure that the economy is thriving and growing, but inflation is not getting out of hand. An example of inflation is like a loaf of bread now costs $2 when it used to cost like 10 cents back then, right? So it's pretty much the increase of the pricing of the goods and services that we are consuming in the economy, right? So we want to make sure that things don't get way too expensive, but at the same time we also want to make sure that there is demand for these goods and services so that people can spend money, so that the economy can actually start to grow and actually expand like a balloon, right? So in that case, central banks, they are the ones that is going to be making sure that that actually happens, right? Inflation is not getting out of control, the economy is also growing as a whole, so that the strength, the value of the currency goes up, and they are able to achieve that objective by influencing interest rates, right? So if they reduced interest rates, what happens next is that people are able to borrow money, right? And if people are able to borrow money, they are going to borrow more money, and then they're going to spend more money. And if they spend more money, the economic balloon that I just described to you just start expanding again. And then guess what? Everybody's spending money, then eventually it gets out of hand, right? Because the demand for goods and services is just skyrocketing. Everybody is buying shit that they don't need. And then next thing you know, the prices of these goods and services start increasing rapidly as well to adjust to this demand. And then to prevent things from getting too expensive, the Feds will step in and increase interest rates to make it more difficult for people to borrow money so that they can actually reduce the demand for goods and services and prices of these goods doesn't go too crazy. And all of this pretty much determine the flow of institutional money. Because in certain environments, institutions, the smart money, they are going to be pouring their capital, the billions of dollars, trillions of dollars into different sort of assets that perform the best in the environment that we are in right now. That's pretty much the gist of it. And retail traders ignore it because of the fact that like it's too complicated, it's too fancy, like all these jargons like interest rates, inflation, monetary policy, like what does all this all mean, right? So as a result, if they don't understand how the big picture works, they will never succeed. Once again, this is something that smart money focus heavily on, right? They use the fundamentals to time entries, right, to rotate the investments, right, so determine like which assets they want to be pouring more money into, and also this will give them conviction on their trade ideas, right? So they are pretty much using this fundamental analysis to position themselves so that they can actually ride the next cycle. Quite simply put, price action, technical analysis, the reading of the charts tells you what's happening in the market, how is price moving, but fundamental analysis tells you why price is moving, right? It's important for you to actually understand why so that you can know what the bigger picture is and you can align yourself with the smart money institutional flow of capital. And this cycle right here pretty much drive everything. Like I said, it's all about interest rates, it's all about printing of money and liquidity to stimulate the economy, right? When inflation gets out of hand, what happens is that things are getting way too expensive. So the Feds are going to step in to increase the interest rates to make it more difficult for people to borrow money. And if it's more difficult for people to borrow money, less people are going to borrow money and they are going to borrow less money. So as a result, what will happen is that they're going to spend less money since they have less money in their bank account and they are borrowing less money. So the demand for goods and services will start going down, which also means that the prices of goods and services is going to start going down since demand is going down, right? That's just basic economic. And then what happens next is that when this actually gets too crazy, right? Because they need to make sure that inflation is at a base rate of 2% every single year, right? So that things don't get way too expensive. But then if they continue to hike interest rates, eventually everything is gonna be getting way too cheap, right? So as a result, what happens is that they will reevaluate, review the economic data, right? To see where we are at in terms of the economic growth and where we are at in terms of inflation. And then this is where they will pause hiking of interest rates, right? So they will not continue hiking interest rates because they know that, you know what, people are not spending money. So as a result, we might need to just hold our horses and just start to actually stimulate economic spending again. And that brings us to the next phase where they actually start cutting interest rates. So when the Fed start cutting interest rates, maybe because there's a risk of recession right now, since unemployment rate is high, right? People are out of jobs. And then also people are not spending money because people don't have jobs. And this is where we are going into the state of, perhaps there's a recession since the economy is actually shrinking and contracting and people are not earning money, people are not spending money. So what happens next is that the Fed will actually cut interest rates. So when they cut interest rates, they make it more easier for people to borrow money. So as a result, people are going to start spending money again, right? They're going to buy the cars, they're going to buy houses. And when that happens, if it doesn't help, if this is not enough to stimulate economic growth again, what happens is that we might be heading towards a financial crisis or an economic slowdown. Like the 2008 financial crisis, like the COVID-19 pandemic breakout. So this is where the Feds will actually unleash quantitative easing, right? So this is where you see the meme of Jerome Powell just printing money. So quantitative easing is basically that, right? It's printing money. It's injecting liquidity into the economy itself. So what happens is that the central banks, they are going to be buying bonds. And when they buy bonds from investors, guess what? The investors are selling these bonds to the Feds, and now the investors got so much money that they don't know what to do with. So as a result, they're going to be spending that money elsewhere, or they're going to be looking for assets which offer a higher return on investment, like stocks, crypto, and other sort of bonds. And then the next thing you know, consumers, they start spending money again because it's easy to actually borrow money from the bank, and they have also this large amount of disposable income that they got from selling bonds, right? So what happens is that they spend money, they stimulate the economy again, and the whole cycle repeats itself again, over and over again. And this is pretty much the Fed's role, right? They want to regulate inflation by adjusting the interest rates, by printing money, injecting liquidity into the economy, while at the same time ensuring that the economy is growing and thriving. So this cycle pretty much describes the macro context behind every single trade. Like I said, nothing in the market is random. It's moving with a purpose. Now let's break this down into the 4 phases that traders can actually use, each with different strategies, psychology, and opportunities. Once again, this is something that I've not seen anyone else talk about it, but I just don't know why, because this is just so important. And maybe that is why these retail traders are losing, right? Because of the fact that the retail traders are just not looking at the same thing that the smart money is actually looking at. Mark Douglas once said that consistently profitable traders don't think like everyone else. If you're thinking like everyone else, if you're trading like the majority, which is this bottom 99% of the crowd, you're just going to get the exact same results as they do. So if they focus on price action patterns and they ignore fundamentals, and they are also losing, then perhaps you need to think as a contrarian, right? You need to start trading and acting like a contrarian, which means you need to start understanding the fundamentals, right? Because this is the edge that institutions and smart money possess, which the retail traders just don't have, right? So let's go through the 4 market cycles. So you can see right here, expansion, stagflation, recession, and recovery. So it's pretty much the same thing like what I mentioned earlier over here, but now we have attached a phase, economic term to each one of these phases right here. So phase 1 is expansion. Now, expansion phase is where the economy is blooming, right? Everything is good, man. Like companies are earning money, the employees, right, which is us, right, customers, people, day-to-day people are earning money because the companies are earning money. So we have a lot of income to spend. And as a result, we're going to spend and buy more shit, right? We're going to buy cars. We're going to buy MacBook. We're going to buy Apple products. We're going to buy houses. We're going to buy shit, right? So the demand for goods and services is going to be going up. So what happens next is that when the demand for goods and services is going up, the economy will grow, right? The economy will grow just like this because the economy is pretty much like a reflection of how much spending there is in that country itself. And then what happens next is that since demand for goods and services is going up, the Feds are going to be increasing the interest rates, right? To make sure that inflation doesn't get out of hand, to make sure that things are not getting way too expensive. So in this particular environment itself, what you can do is to long risk-on assets, right? Because this is the stage where investors, traders are greedy. They are feeling this sense of FOMO, right? So they are feeling this sense of confidence that the economy is just going to continue going up and we are very, very bullish. So as a result, what will happen next is that money, institutional flow is going to be flowing towards risk-on assets, risk-on currencies like Australian dollar, the New Zealand dollar, and the Great Britain pound. And then it's also going to be flowing towards your growth stocks, your technology stocks like Tesla, Nvidia, Microsoft, Apple, Facebook, Meta, whatever. And it's also going to be flowing towards crypto, right? Bitcoin, Ethereum, Solana, whatever. Right? Once again, because of the fact that investors are feeling bullish, investors are feeling confident. So they are going to be parking their money into these more risky assets, knowing that they're just going to continue going up no matter what. So this is where you want to be using trend following breakout strategies. You want to ride the bullish trend, right? Because everything is going up right now. So you want to make sure that you are taking advantage of this huge bull run by entering early so you can ride this huge move to the upside. And an example of this phase is the 2021 post-COVID-19 pandemic, right? So after the COVID-19 pandemic where shit hits the fan, everybody thinks that the world was going to end. What happened next is that in order for the Feds to stimulate the economy again, they actually started cutting interest rates. They actually started to inject liquidity into the market. And then a year later, the economy started expanding again, right? Everybody is bullish again. So what happened is that the Feds have to actually intervene by hiking interest rates to make sure that inflation doesn't get out of hand again, right? And then next thing you know, we go on to stage 2, all right? Phase 2, which is stagflation. Phase 2 is a tricky one. Phase 2 is where we have the worst of both worlds. We have high inflation, which means things are expensive, right? Demands for goods and services are low since things are expensive. And we also have high unemployment rate. That means people are actually out of jobs right now, right? People don't have money to spend. So imagine this. You're out of job, right? You're unemployed. You're not getting any salary from your company and you're sitting on your couch. And then you go to the market and you realize that a loaf of bread is like $5. And it's like, what? My favorite carbohydrates is $5 and I'm out of job and I'm broke. So how am I gonna buy this loaf of bread? So as a result, I'm not gonna buy it. So I'll just go home hungry, whatever. And next thing you know, everybody start feeling the same way about things, right? Because things are so expensive, but they are not earning enough. So you can see there's this like huge discrepancy. So this is where we are in stagflation, where there's high inflation, where there's weak economic growth because unemployment is high. And this is where central banks realize what they have done, right? So they reevaluate the situation and they stop hiking interest rates. They stop increasing the interest rates because things are already expensive enough. So this is where the economy could be starting to head into this downturn, right? Economic downturn, where things are just about to like 180 turn, but not yet. So this is where you can look for longs for more risk-off assets like the Swiss franc, right? Safe haven currencies like the Swiss franc, the Japanese yen, and the US dollar. And then you can also look to long commodities which tend to perform well under price pressures like gold, oil, so on and so forth. So this is where, because of this state of uncertainty in the market tends to be quite choppy, right? Just goes sideways just like this, right? There's a lot of confusion in the market. There's a lot of fear, and maybe not fear yet, right? Because people are still feeling confident. They are just in this state of denial where, the market has been in this massive bull run and the market is starting to show signs of weakening and the market is start turning bearish again, but they refuse to accept the fact that they are wrong, right? They let ego blind their judgment. So as a result, they continue holding the back. And a good example of this is 2022, right? Where we have this huge economic bull run, but then inflation is high, right? But things are getting way too expensive. Which brings us to the next phase. So phase 2 is pretty much the leading indicator. It's the first sign that tells us that the economy is about to go into a recession. And then phase 3 is the recession, all right? The recession is where Feds begin to cut interest rates, okay? Because of the fact that, like I said, things are expensive. People are not spending money. So in order to incentivize people to spend money, they have to cut interest rates so that people can actually borrow more money. And when they borrow more money, they will be able to start spending money again and the economy can go back to normal. So this is where they cut interest rates and institutional flow is pouring towards risk-off assets like I mentioned earlier, right? Like the Swiss franc, USD JPY, gold, and even bonds this time round, right? The US Treasury bonds, the 2-year bonds, the 10-year bonds, the 30-year bonds. And this is where you can play defense instead of offense. So this is where you can start using defensive swing strategies or short-term momentum plays. Because the market is going to be starting to go into this free fall where everything is just collapsing, stocks is going to be collapsing, crypto is going to be collapsing, and then risk on assets like GBP is going to be collapsing. What you can do in this particular case is to short these currencies, short these risk on assets, and try to ride this short-term bearish movement to the downside. And the psychology of the market in this case is fear, right? A lot of people think that, oh my God, the world is gonna end, everything is gonna go to shit, we are in this crisis, we are never gonna get out of this, right? So this is fear, right? This is what the market is feeling right now. This is their sentiment. And this is where everybody is gonna be panicking, selling, right? People are gonna be selling off their crypto, people are gonna be selling their stocks thinking that, like I said, everybody's going to go to shit. Everything is going to go to shit, right? So they're extremely pessimistic in this particular case. So an example of this is the 2008 financial crisis. Another example was the 2023 banking crisis, or the COVID-19 pandemic, right? Whenever there's like a huge black swan event, right, where something is going wrong in the economy, something is going on in the world, right, where we have like a war amongst different countries, where we have like a financial crisis, where we have like a bubble, and then all of these events will pretty much trigger like a recession, and which will bring us in this particular phase right here. And then the last phase is the recovery phase. Okay, so this is where you can see the gross domestic product, right? The economic growth is low, right? It's down right now. So as a result, the Fed is going to be cutting interest rates, and they are also going to start printing money, right? And release this process called quantitative easing, where they are injecting liquidity into the economy by buying bonds from investors. Okay, so this is where a lot of investors, they will be buying the dip, or rather this is the best time to actually buy the dip. And this is where you can also start to look for longs for assets like Australian dollar, NZD, GBP, right? Pretty much like what we have earlier on over here, technology stocks, Bitcoin, because right now we are able to really buy the bottom, buy the dip, right? And actually ride the next move to the upside just like this. Okay, so this is where you can use reversal trading strategies, and you can look for breakouts with macro tailwinds, right? You want to really look to long this risk on assets, because we know for a fact that these stuff are most likely going to return to all-time high, or at least just go up over the next few months or so, since the economy is getting stimulated again. So the psychology, the sentiment of the market is hopeful, right? They're feeling like, okay, you know what, maybe this isn't so bad after all, right? The world is not going to end, right? It's just temporary. So this is where we'll return back to a bull run. And people get disbelief. Maybe people who are left holding the bag and they short at the bottom, now they're thinking, wait, what? This was just like a scam, right? And then people who are getting in early, they start celebrating their wins. Okay, and then the example of this is the 2009, after the 2008 financial crisis, where the economy gets back to normal. And also the 2020, after the COVID-19 pandemic, where the economy once again gets back to normal. And even the late 2023. Now, I'll give you like a more recent example, right? So when Trump actually announced like the thing about the tariff, what happens is that the stock market crashed massively. And then next thing you know, the stock market recovered over the next few months, right? And it's really like this phase right here where investors, they start feeling hopeful. They start feeling like, you know what, things are not so bad after all. And they start gaining confidence over the economy again, right? So they start pouring money into the risk on assets again. So that's pretty much the 4 phases. That's pretty much the 4 market cycles. You can see I've included like a little you have right here. You can just take this down in your notes. The reason why this actually matters is because most losing traders, they treat every market the same. They're using the same strategy in every single environment. Like they use the same setups in 2022 as they did in 2020. And then they get burnt and they wonder why. Well, because you are not adapting. You're not actually adjusting to what the market is doing right now. So understanding where we are in this particular cycle here, it helps you choose the right assets to trade. Avoid going long during a recession, right? or short during quantitative easing. And this is also where you are able to find out when to risk big, right? When to stay out of the market, when money is flowing to risk on assets, and when money is flowing to risk off assets. And this is where you can also catch reversals before the hurt, or right trends while they are strong. Now, remember this, your setups are only as strong as your directional bias. This means that whatever your entries are on the charts, it will only work if it's in alignment with the macros, if it's in alignment with the macroeconomic factors, especially if you are swing trading, especially if you are intraday trading. This still affects scalpers, right, regardless, because short-term moves are often related to actually macroeconomic factors, but I'm just saying that this will affect the position traders, right, people who are holding the trade for months, if not weeks, and even the swing traders as well. And when you can combine technical precision with macro alignment, your edge multiplies. Like I said, this is something that retail traders are not aware of, right? So if you can really understand this and you can synthesize this information and you can actually apply this, then my friend, you're going to be a very rich man. So the question becomes, which phase are we in right now? So at the time of recording this, we are in August 2025. Okay, so we are actually in this phase right here. We are transitioning from phase 3, which is the recession phase, to the early phase 4, which is the recovery phase. So we are somewhere right around here if we are looking at it in terms of this curve right here. Now, the reason is very simple, okay? Inflation is falling globally, especially in the United States, but not yet at target. And growth is also softening, right? Because we are seeing weaker retail sales, which prove to us that there is lesser demand for goods and services. And we are also seeing rising unemployment claims, which means that people are actually out of jobs. And Fed has also hiking of interest rates. And they even talk about, cutting interest rates in Q4, right, over the next few months or so. So like I said, we are potentially heading into this phase right here, but we are not in this phase yet. And this is where you can see equities have also bounced massively, right? But right now, the breath is still weak. And then risk-on sentiment is creeping in, but fragile, right? You can see money is pouring into S&P 500, money is pouring into crypto. Everything is like quite bullish right now. But then there is still this state of like uncertainty, not knowing where the economy is going to go, right? The investors are not particularly euphoric or greedy or extremely confident right now. They're just in this state of limbo, right? Where they are confident but not super confident. So here's what's working right now. You want to make sure that you long risk on currencies, right? So I'm talking about the Australian dollar, the New Zealand dollar, and also like the Great Britain pound. And you also want to be longing crypto, right? Like Bitcoin, Ethereum, right? Because once again, investors are confident, which means that they are more likely to take on more risky assets, more volatile assets like crypto. And then you can also look for longs for technology stocks. And also, this is where, like I said earlier, we are not heading into this yet, right? Which is why there is still some defensive flows. So make sure you do not over leverage whatsoever. And you want to watch for quantitative easing, stimulus, or rate cuts to confirm full phase 4, which might happen in Q4, right? Q4 phase 4. Is it a coincidence? I don't know. But it might happen, right? But like I said, it might happen or it might not happen. We will just adapt based on what the Fed is feeding us, right? What new information is coming towards us. So if it does, then just know that, okay, we are heading towards this phase. And this is where you know that these are the stuff that you want to be doing. Right? So yeah, you can see just by understanding which cycle you are in right now, which phase you are in right now, you are pretty much able to anticipate trends and you are able to know when smart money is going to be flowing their money, investing their money into the assets that you are trading. So you can expect when those assets are going to be going up. That's why we understand market cycles. So if you want to go deeper into this, we've got an entire course module called Fundamentals Mastery inside the 1% Club, which I literally just released to my students a few days ago because we release like one new course every single month. You can see is this one right here, and this is where you can see all the lessons that we actually have available for fundamental analysis, right? And the reason why we actually do this is because we want our traders to be full stack, able to think like smart money and not just follow setups blindly or follow signals like bloody idiots, like the sheep heading to the slaughterhouse. And the thing is, most trading courses out there, they skip this completely. All they teach is technicals, chart patterns, candlestick patterns, which is information that is available online, right? And they just neglect fundamentals, which is what institutions are actually focused on. And the thing is, we focus on technicals as well. We heavily focus on technicals. We want to make sure that you actually understand how to analyze the charts, but we also focus on the other areas that will actually make you profitable, like risk management, like trading psychology, and now fundamental analysis as well. We teach you how to read macro shift early, how central banks actually move markets, how to align your strategy with regime changes, and how to use news as fuel, not fuel. That means how to trade the news, how to actually take advantage of market manipulation during high impact news, how to actually write the institutional flow properly when the market takes into account the updated information from the Feds, from the central banks. So if you're serious about mastering all sides of trading, right, developing multiple mental models, technicals, psychology, fundamentals, risk management, mindset, join the 1% Club, because that's what it takes to be consistently profitable, right? That's what it takes to become a professional trader who truly understands the game at the deepest level. By mastering market mechanics, which is how to interpret price action and how institutions are actually trapping retail traders, by understanding capital management, which is how to actually make sure that you're not risking too much money on each trade so that you can focus on capital preservation and you can grow your account, and how to actually have the mechanical systems and processes so you can execute without hesitation, reservation, or fear, with confidence, clarity, and conviction. And also, fundamentals and trading psychology on how to actually master the mental game, how to actually defeat the inner demons, the subconscious forces that is preventing you from actually becoming profitable. Like I said, we give you every single thing. We give you 3 coaches, we give you over 500 plus lessons so that you got everything you need to become successful. Alright, so I want you to be honest right now. Do you know about these 4 macro cycles before watching this video? Because I got a feeling that you don't, right? Because this is something that I don't think there's like a video out there which explains this in the trading niche. So I just wanted to make this, right? Because like I said, I'm all about giving, bro. I'm gonna tell you whatever I've learned throughout my entire trading career. That's the point of this channel. So comment #knew this if you've studied this before, if you have chanced upon this. And I also want you to comment mindblown, #mindblown, if this has opened your eyes, if you haven't actually learned about this before, right? So just go and comment, leave a comment. I'll be checking every single comment, and I always love to see you guys engaging in these videos because it shows me that you're actually listening to me for like 1 hour. All right, so with that said, I hope you guys have enjoyed this video, and if you want to learn more about trading, you can check out this free 10-hour course that I just created right here. And as always, remember, you're just one trade away.